going on, guys? It's Christopher from Stock Hours. Today's video is about market versus limit orders. So we're gonna kind of find out whether you should use market, whether you should use limit. Maybe you want to use a mix of both in different scenarios. Market orders basically they guarantee that you get in as soon as possible at whatever the best available price is. A limit order is it's not a guarantee that you're going to get in or get out right away, that your order is going to get filled right away, but you will get filled at a better price. So, a situation where I use market and pretty much all of the stock hours traders use market is getting in a trade. We don't want to risk missing a trade because we had a limit buy, and if we're trading on a momentum move, then our limit buy is never going to get filled because the stock is continuing to move away from those limit buy orders. So they would be filling closer to the ask rather than the bid on a options contract. So when we're buying market, we're making sure that the spread in our options are tight so that we're getting filled as close to break even as possible. Every option or even every stock is going to have a little bit of a spread, but the tighter the spread, the better your fill is going to be when you're buying market. So if you're buying limit, there's going to be a lot of plays that you're going to miss just because if the stock continues moving, and in a lot of our momentum trades, the stock should continue moving, then that limit order is not going to get filled there. So that's why we always buy market. The chance of us not getting filled is not worth it to us, especially on tight spread contracts. And then now on the sell, it is where if you have a lot of screen time and you know what you're doing, you can get away with selling limit. But if you're new, I always recommend selling market. It guarantees that you're getting out when you hit the button. There's no extra games being played. It's basically when you hit buy market, you get in. When you hit sell market, you get out. And if there's a tight spread, the difference is not even noticeable a lot of times. But let's say you've been trading longer, you want to start practicing selling limit to get a little bit better of a fill on your plays. What I look for on trades where I'm selling limit, I want to be selling during the momentum push in my direction. So let's say we're playing upside. The stock is trading around 320 and we're pushing up into the 321 break. If I'm selling while the stock is continuing to move up, my limit sell has a much higher chance of getting filled. But now let's say we break 321, but we wick and we come back down, and then I set my limit sell, I might not get filled. Because basically your order is set at the top, and if the stock is moving against you, then people are placing orders below yours, and your order is just sitting there waiting to get filled. So unless if the stock reverses and comes back up, your order is just going to sit there and not get filled. So that's one of those situations where you on a pullback or a loss of momentum, you should really be selling market most of the time. Now, something I do want to add to that, there's basically two brokers that we recommend trading with is Thinkorswim or Interactive Brokers. On Thinkorswim, the limit function is basically just join the ask. Like when you're selling, it's just join the ask. So whatever the ask price is, that's where your limit order is going to get set. If it hits, you sell. If not, your order is just going to be sitting there waiting to sell. And it might not ever come back up to that limit price. So you might not get filled. What was once a 10% green trade could pretty quickly turn into a 5% or even break even if you let your limit order just sit there waiting to get filled. Now, Interactive Brokers, they have different kind of functions within their limit buttons. So you can set your limit at the ask or a certain amount before that. So what mine is, I think it's at the ask or a percent 0.75, so 1.75% below the ask, so that this way I'm much more likely to get filled. And especially if there's a tight spread, you should get filled right away, either at the ask or whatever's closest to it. So if you have interactive brokers, there's going to be a higher chance of you getting filled pretty much right away. But there is still that risk that if the stock pulls back, that your limit order is just going to be sitting there waiting to get filled, and you might not get filled. So that's another thing to keep in mind, is the broker and what a limit button actually represents for that broker. So like I said on Thinkorswim, is basically you set your limit order at a price. If it hits that price, you sell. If not, you don't sell. Interactive brokers is more of a wider sell area, so it's either the ask or you have a small range below that where you could sell. So another thing about when you're selling market or selling limit is different scenarios where you want to do one over the other. If I'm taking profits, I might consider selling limit, but if I'm stopping out of a trade, 100% of the time I'm selling market. Or another thing that it might be called in your broker is flatten, which is basically sells your entire position as a market order, but it's all basically under market. But now let's say you're looking to stop out of your trade, you hit your stop loss, and then you set a limit sell. If the stock continues going against you, your limit sell could again just be sitting there while the stock continues going against you. So if you wanted to cut your loss at 7 or 8% and you set a limit sell and the stock continues going against you, you can turn that 7 or 8% loss to a 10, 15, 20%, basically as far as it's going to go before you cancel that order and sell market or flatten. So like I said, with market, you are guaranteed to get out once you hit the button at whatever the best available price is. Limit, it gives you the ability to set what you want to sell at. So obviously if you're stopping out, you should just sell market. You just want to get out right away. You don't want this loss to continue going against you. And if you're selling limit, then you're just setting a price there. But if it continues going against you, then your limit sell is just going to be sitting there, and there's really no say that it's going to come back and fill that order. And then now, one of the last things I want to mention about market versus limit is the overall risk reward of even placing one of those orders. So when you're getting into a trade, you're usually looking for a minimum 1-to-1 risk reward, hopefully more than that, like 2-to-1 or maybe 3-to-1. But now when you set a limit order, your risk is not getting filled right away, and your reward is going to be basically the difference of the spread. So if you're selling market, you're going to be selling at the bid. If you sell limit, you're selling at the ask. So some stocks have a wider spread in their options. Some stocks that I know off the top of my head, Netflix usually has a wider spread. There's occasions where Nvidia spread is a little bit wider, but that's really just because contracts are more expensive. But let's go with Netflix, for example. I've seen times where Netflix spread is as wide as $20. So if you're selling market and if you sell limit, let's say you send, or two different people send the order at the same exact time, then the person who sells market is going to sell at the bid, and the person that sells limit is going to sell at the ask. So if that's a 20-cent spread, then the person who sold limit would have made an extra $20 on their contract. But now with that obviously comes the risk of them not getting filled right away. But a situation like that is where I would be more inclined to want to see if it's worth me selling limit during a push in my direction, because the reward of actually getting a limit order filled is much higher on a stock like that. But now when you go to a stock like Apple or SPY, those contracts usually have a very tight spread. Let's say SPY, for example. Pretty much anytime I look at SPY contracts, the spread is $1. So if you're selling market versus if you're selling limit, the reward of you selling limit is getting an extra $1 on your contract. The risk is you not getting filled, the stock pulling back, and then now you lost 5% or maybe even more than that, depending how long you leave that order sitting in the market. So a stock like SPY, I don't even entertain the thought of selling limit because it's not worth it pulling back on me and me not getting filled. But if I sell market, I know I'm gonna get out right away, right when I hit the button, and I'm not, I'm taking technically a $1 difference in my contract. So something like that, I find it always worth it to just sell market to basically get out when you want to get out and get in when you want to get in. But that's pretty much everything there is about market versus limit. So basically for me, I always buy market. There's really no scenario I buy limit. And if I'm selling limit, it has to be in a push in my direction, or else I'm going to sell market. And anytime I stop out of a position, I either sell market or I flatten, which is basically the same thing. It's just that flatten sells your entire position, sell market sells whatever quantity you have inputted in your active trader. But that's it for today's video. Pretty simple. Hope you guys are having a good week. Make sure you guys like the video, comment any suggestions that you have for future videos. But that's it for me. Peace.